Hey, good afternoon. How's everybody?
Hey, Professor.
Hi, how are you? Uh,
Well then,
okay. Hey, hello. Now, I guess my computer has reset. And looks like I've lost some setting. Uh, can you guys see my profile picture? I think I lost my profile picture. I'll have to
No,
probably, I'll have to reset it. Okay, I'm sharing my screen. Yeah, that's true. And looks like I can't see my. Okay, let me. Um, looks like my profile picture is gone. So let me open. Mm, okay, I'll use more cheerful look. Hopefully. Okay, there you go. Alrighty, and I'm sharing my screen. And I see, okay, there are 10 people. So, and what happened to my microphone? I mean, my speaker volume. Okay, say something now. Can anyone say something now?
Professor.
can you hear me?
Yeah. Good. Yeah, loud and clear. So everything was just it just automatically reset itself. So even the speaker is uh, was at its lowest level. Okay. Um, so uh, I believe in our last class. Okay, financial statements. So this is what we. Um, okay, so we were done. I don't know why this is all filled in, but it should be okay. Hmm, case clean. So your homework is already due today, but we have a couple of more. Okay. I mean, if you haven't submitted yet, we have until 11:59 p.m. tonight. So until then, um, the next thing that the next thing we need. This is something also directly related to your homework. First of all, there are uh, the balance sheet and income statement. Basically, we need two balance sheets, and I probably mentioned this at the beginning. Balance sheet of the previous year, end of previous year, and the balance sheet uh, at the end of this year. Of course, we're not at the end of this year, but uh, if you're at the end of this year, then we need the balance sheet at the end of the last year, and the end of last year is the same thing as the beginning of this year because always, end of think about it, end of 2021 is what midnight December 31st of December 2021. But think about it, midnight December 31st of any year is the same thing as the zero the beginning of January 1st of the new year, right? So that means we need the we need the balance sheet of time at time 0 and the balance sheet at time 1. I mean, we always need to compare what happened during the year, right? What happened? Uh, how much, increase or decrease there has been, right? But again, um, as I said, all the financial statements are updated quarterly, right? Every quarter. Anyway, you need to close the book and which means settle everything, settle the account regularly, right? And quarterly at the end of each quarter. That means at the end of each quarter you will need to update everything on your financial statements. Therefore, although I'm talking about the when I say two balance sheets, end of last year and end of this year, that can apply to the end of last quarter and the end of this quarter, right? The and we can basically compare what happened. We can compare these two statements and compare what happened between the end of last quarter and end of this quarter. I mean, we do this constantly on quarterly basis, right? But just to make it simple, let's say we do this, at the annually. So we want to compare what has happened, between the end of 2008 and end of 2009, and it's simple. Finding, basically, what happened is basically a change. Finding the change between change between 2 years, right? So the change is either increase or decrease. So we identify the change by the dollar amount and in percentage, which is not a difficult thing. I mean, the change happens always, from the past to the future. So I mean, from the past to the present. So to find the dollar amount, change in dollar amount, all you need to do is just subtract the past from the present, right? And then, which is not a difficult thing, and then the rest of them are the same, so we can just drag them down. Okay. I'm gonna drag it down. Okay, I'll drag it down. So here, just drag it down. Okay. So we have all of these cells. We find the changes, instantaneously. Now, but wherever there's no data, right? We simply need to delete those cells that contains no data. You might wonder, what about here? What we don't? It's gonna appear, right? It just has no data because we didn't find total current assets. But once we find the total current assets, it's gonna be automatically populated. But the cell like this, cell like these, they are basically empty cells. They have no data. So something like that we need to clear, right? We need to clear those cells. Clear those. Okay, and then Um, Now, what about this? Total current assets, 2009. All we need to do is simply uh, use, auto sum, right? Using auto sum command. It's gonna sum everything above it. Only if the range is contiguous. Only if the data range is contiguous. What does that mean? With no gap. If there's a gap, it will stop at the gap, right? It doesn't include, it doesn't, include the data range, after the gap, right? So, and then we can simply copy this to the right, okay? And then automatically we have the increase or decrease. Also the same thing here, auto sum. Uh, um, this is so slow. No, what's going on? Okay, there you go. And here, of course, total assets is sum of total current assets and total non-current assets or fixed assets. Okay, and I will drag it to the right. Drag it to the right. No. Okay, and drag it to the right. So automatically they are filled in. Total current liabilities, also the same thing. Auto sum and all. And see, since there has been no change in total current liabilities, right? This cell is, of course, 0, right? Um, but as you can see, that formula is already filled in there. And then also auto sum non-liabilities or long-term debt, and also auto sum. Okay. Automatically filled in. Now, total liabilities, of course, then it's the sum of these two, right? Current and non-current. And then copy that to the right. Okay. And then equity is not given, but if the equity is not given, we already know what, by definition of the balance sheet, total liabilities and equity must be equal to total assets, right? Okay. And then what is the equity? It's the difference between, right, these two numbers, right? And there you go. Therefore, you can just highlight those two and okay, and then drag it to the right. Okay, so that is now showing you even the change, right, must be the same, right? Because it's balance sheet, they must be balanced out. Okay. Now then, increase or decrease the change in percentage. Of course, the change is, in the cash, right? In case of that line item, change is always what? The growth, or the rate of change. So it's always the over, right? That that the portion that has changed, right? Divide by the base year, and of course base year, 2008, right? And there you go. And of course, the change has been negative in percentage. That was negative, 16.67%. And if I drag it down, stop there. Okay. Now I got the now, of course, the cells that don't contain any data, it's your responsibility to make it look neat, right? If you leave it like this, no, this is obviously unprofessional. I mean, suppose you are, let's say, showing this to your clients. Obviously, that's not, that doesn't look nice. The clients want, right? So you'll need to clean that up. Oh, yeah. Okay, and finally, you see, as I drag it down, that the borderline at the bottom got erased. So I'm gonna put it back in there, thick bottom border, right? Because if it is not, that's not professional. Okay, that doesn't look neat. Now, the next one is, so this, what we just did is just very simple process, but it shows, the increase or decrease, or the change in each line item in the balance sheet. This is called horizontal analysis, because you are, the term horizontal is rather very primitive, because you're looking at two, balance sheets side by side, so it goes horizontally. That's why it's called horizontal analysis. But I would, the better term would be, I would say, intertemporal analysis. Intertemporal meaning, between two time points, right? Between different time points, intertemporal analysis. Or I would also call it dynamic analysis. Dynamic means, change, right? When we say dynamic, you think about the word dynamic might inspire some, movie scene, where there's a lot of action, right? Or dance floor. There's a lot of dynamism. But think about it. Dynamic means, dynamic has something to do with time, because if there's no time, everything is static. Isn't that right? And with time, something changes. Everything changes with time, right? Think about it. Everything changes with time. So, and if you are, if you're going from point A to point B, it will never happen if there's no time. I mean, time between point A and point B, there was time, right? And if you're just looking at point A and point B, right? It's static picture, right? And if you are recording every phase or every step, every movement by what do you call this? Still frame by frame, right? Then if you run it fast, then it captures the motion, right? It captures your movement. So that's then it becomes dynamic, right? The picture becomes dynamic. But again, so the word dynamic means actually a change, and change is inevitably caused by time. If there is no time, there's no change. So the better way of the better name is, I would say, dynamic analysis or intertemporal analysis. But in accounting, they call it horizontal analysis. And next, this is called vertical analysis. What's vertical? It's just it goes vertical. That's why. And think about it. It's basically what we are trying to do here is to find the percentage of each line item in the balance sheet as percentage of the total assets, right? So here, let's first, let's fill in the missing values, right? Of course, it's the sum. You can use auto sum and so be like this. And also, I'll just use auto sum. And then, of course, total assets is the sum. Okay, and we got, and the total assets will be the base, right? The basis of all this, comparison, because as what is the percentage of our cash out of our total assets, right, and etc. Now, also total current assets, right? We'll use, I'll just use this one. Okay. There you go. Also total non-current assets. There you go. And the total liabilities will be sum of these two numbers. No. Non-current liability, current liabilities and non-current liabilities. And there you go. That's total liabilities. And then equity is given. So then, total liabilities plus equity is, add these two, or because it's bound to be the same thing, equal to total assets, right? You can point to that, or make sure we gotta make sure that they are the same number or they balance out. We'll sum these two and then come to, oops, what happened? B23, B25. I guess this is what is going on? What's going on? Something's not right. I think sometimes this happens when the format is not, some number format is not correct. Oh, this wasn't actually, I don't know why this is. Okay, so equity wasn't given. Okay, equity wasn't given, we'll have to make it equal to total assets, and then that will give us equity. So it looks almost as if, okay. Now, so vertical analysis, as I said, is basically, what's the percentage of each line item what is each line item as percentage of the total assets, right? Since I'm going to, you can, now you will, is it, so I'll need to lock this. Do I want to alt this, shift this? Where's the, what happened? Oh, what happened? Okay, let me close some windows, some causing so much. Okay, it's very slow. All right, so go back up. Oh, come on, move. Okay, the mouse is acting up like. Okay, so okay, come on. How can so stuck like this? Okay, each line item divided by total assets. And then we're going to lock. So I think locking this was Yeah, but it takes time. And always don't forget, at least 2 to 3 decimal places. Close. Okay, please close. Close. And then, because the denominator is locked in this, right? We can just drag it down. Just drag it down all the way. Okay. So we got, and then again, clean out. Please clean out the cells that actually don't contain any data, right? You must clean this out, otherwise, it will be penalized. Okay, and then the bottom thick border that was erased because I copied and dragged it. I'll put it there. You have to. Okay, then it's going to be neat. So now this tells us what is the point of doing this? Well, your total current assets is almost 50%. I mean, less than 50% of your total assets. What kind of if this is most likely if it is manufacturing, the ratio wouldn't be like this. I mean, you can if it is manufacturing, the fixed assets portion, fixed assets would take the majority of the total assets, right? Think about it. If you're a manufacturer, your plant and equipment will be almost 80%, right? 70. But having a big huge fixed assets may not be seen as uh, a nimble or agile structure, because if you have huge fixed assets, basically huge fixed assets are, in terms of liquidity, uh, not that easily liquidable, right? That's why they are long-term assets, because that's why they are fixed assets. They are not liquid assets in the first place. But um, uh, a business with higher ratio of a business with high ratio of current assets to current assets over non-current assets are relatively uh, liquid and nimble structure. In other words, they can easily close up or close down and move on to uh, another line of business, or another location. Whereas if you have a huge proportion of fixed assets, it's not that easy to do that. And it goes without saying that online retailers generally have very nimble or agile structure, because they don't have that much plan. They don't have that much fixed assets. They all have all they just rent a big warehouse, and all their inventory, keep all their inventory in the warehouse. And since they are not manufacturers, they don't need plant and equipment. and then they just ship their goods from the centrally located warehouse. I mean, if the warehouse, just like Amazon, if warehouse is located in the middle of the in the middle of geographic center of the country, I mean, it's easy. Cost of transportation cost is relatively, it will be cheaper, much cheaper than shipping from coast to coast, right? But anyway, the question is, okay, I'm going to ask this question together with this. So here, then what is this? 2009, 2008. This is basically a vertical analysis. I want you to do the vertical analysis. So, okay, 2009, each line item divided by total assets, and then you lock it. You gotta lock it. Okay, lock the bottom denominator. What did I press? Alt search, and why doesn't it work? All right, sorry about that. It looks like I got the browser suddenly shut down, and I had to revive everything all over again. So where was I? Okay, so at least it's a good thing I could instantaneously got it back. So basically, if you want to do the vertical analysis, of course, the same thing. You'll divide each line item by total assets, and of course, you need to lock the denominator. What's going on? Am I again? Okay, it takes so much. Okay, I got it locked, but where is my? This is a full screen thing, so how do I get it back? Nothing to redo. Okay, can you? I don't know if this. I'm out. I'm outside the browser now, so I don't know if you guys can hear me. Can you hear me? Anyone?
We could hear you.
And you can see my screen. You can see my screen because it's full screen now. Okay, I don't know how to turn it back to the.
You see it.
Okay, good. Alrighty, so we do vertical analysis by okay, and then clean out all the blank cells. Okay, clean out all the blank cells. Blank. Okay, and also for 2008, we do the same thing. Okay, for 2008. Here's the total SS divided by total SS, and block the denominator. So this doesn't work that well. Okay, I got it. And then drag it down. So again, oh no, I didn't. Wasn't it locked? Oh, it wasn't locked. That's why I thought it was locked. Okay. All righty. There you go. Oh, where's the lock? Okay, there you go. All righty. So let's drag it down. And then clean out. Okay, clean out. Contents. So again, it's your responsibility to make the final product look neat and professional. So here, finally, just some, housekeeping, right? The bottom border, let's give it back. Okay. All right. This way, you have done the vertical analysis and horizontal analysis in a single shot. But here, what is the meaning? What is the meaning of course, we know it tells us, how much each line item has changed over a year, right? Not only that, is this change, the interpretation, this is really, a hard part, and it takes a lot of time. But let's think about it. Negative change seems bad, isn't it right? But our cash went down by 16%, almost 17%. Is this a good thing, or our cash holding went down? It was a negative change. Is this a good thing or bad thing? Can anyone tell me, is this a good thing or bad thing? When the cash holding went down.
A bad thing?
Nothing? Or
That's
did you say not? Bad thing. Okay. And who said bad thing?
Sadie?
Sadie. Okay. Today is. It's actually, no, it's not a bad thing.
If money goes down, it's not a bad thing. Aren't you losing money?
No. Why do you think you're losing money? I mean, that cash is your cash holding, and losing, if you say losing money, lose money, what does that mean? Lose money means, making loss. In other words, not making profit.
Okay.
But the profit is income statement line item. Income statement line item, and this is not income statement. The balance sheet doesn't, I've been telling you over and over, balance sheet isn't about profit. Okay? The income statement is about profit, and the balance sheet is not about profit. And then what is the balance sheet about? The balance sheet is about uh, the balance sheet is about the capital structure. So, and think about it. In the income statement, profit is the result of sale, right? Profit is the result of sale, in other words, revenue. And when you sell something, it doesn't have to be, you don't receive, the form of payment is not only cash. You don't necessarily receive only cash, right? Remember that? The revenue is not in cash necessarily. Some of it may be cash, but some of it is not cash. Remember? You can receive, in other words, the payment could be in the form of promissory note or in the form of accounts receivable when you sell something, right? So so profit is not necessarily in the form of cash, okay? But so when this just represents cash holding that the company has, but how do we know? The whole point is, what happened to the current asset, total current asset? Did total current asset go up or go down?
It went up and increased
Yeah,
3.7.
it went up. Yes, it went up. It went up, right? That's what's important. And also look at the total assets. Did it go up or go down?
It went up.
It went up. Yes, of course. So the point is what? If the total assets went up, that means the company grew, right? The size of the total assets grew, and also the size of that growth came partly from current assets and partly from fixed assets. They both grew, right? And then look at the securities. What happened to the securities? Securities are what? Stocks and bonds, right? In other words, liquid assets, right? So the liquid assets, stocks and bonds, went up. So
Professor,
what does? Mhm.
I understand all that you're saying, but you were telling Sadie that if she loses cash, she's not losing.
No. That's right. I mean, that doesn't mean you're making a loss, right? Cash going
Overall,
down doesn't cash going down doesn't necessarily mean uh, the business making loss. Okay, why? Think about it. You see, $2,000. I mean, cash went down $2,000, right? But then marketable securities went up by $2,000. So what does that mean? They simply switched place. Isn't that right? They simply switched the place. So what does that mean? This is instead of holding $2,000 in cash, you use that $2,000 to buy stocks and bonds. Make sense? And why?
okay.
First of all, cash holding and when we say cash, what does that mean? That's the cash in the checking account, right? Because nobody holds cash in their hands. Isn't that right? Is there any? I mean, if you have $2,000, will you be going around with $2,000 in your hand? Huh? That's obviously nonsense, isn't that right? Cash holding doesn't mean it's just a metaphor, right? When we say cash holding, That's not really something. Obviously, anybody would understand. It would be cash held in the checking account, right? But then, if you either whether it is really cash in your pocket or cash in the checking account or cash in your hand or under your mattress, does cash earn anything? Does cash earn anything? Hmm? It's a very simple question. If does cash earn anything?
If it's in the bank, if it's in your account,
Yeah, if it's in your account, does it earn anything?
if it stays there long enough, interest.
No, no, no. First of all, what did I say? Cash holding means cash held in the checking account or in your pocket or in your hand. And does the checking
Okay,
account pay
so then
anything?
it doesn't so then it doesn't earn anything.
It does. Cash doesn't earn anything. That's what. Of course, some checking accounts pay something very, uh, very mediocre, minute, or very token. I mean, these days. But think about it. Checking account basically doesn't pay anything, right? Savings account pays something. Savings account pays, but these days they pay basically, very even savings account pay uh, almost
And
immaterial interest, right? I don't know if you ever, if you have savings account. Most of you would have savings account, but does it pay anything? It pays very meager interest rate, right? Savings account pays very, not even 1%. And then it goes without saying, checking account pays nothing. So, so what is the point? The point is, um, it doesn't pay to hold a lot of cash. So what they do, of course, you need to hold some cash, right? But because you have to make payments and the payments in the current liabilities, payments in the current liabilities line items are short-term payments, the payment obligation that you have to, right? Short-term payment obligations that you have to meet in the short term, right? So you need to have, but it doesn't really matter because short-term current liabilities, as long as your current assets are greater than current liabilities, you're okay, you're covered, right? Because you don't have to hold a lot of cash, but let's say you have current liabilities, becoming mature. That means the uh, payment is due very soon. Then, as long as you have sufficient, current assets, you can always easily turn it into cash. It's liquid, right? I've been telling you, current assets are also called liquid assets. They can be turned into cash, and you can make those, payments. So that's why I'm saying, holding too much cash is meaningless, is pointless because it's not earning anything. But instead, if you hold it in, stocks and bonds, it earns something, right? If you if you hold it in bonds, it earns interest. If you hold it in stock, there's dividend. Of course, you may have capital loss from the stock holdings, but that's the risk you have to take if you want higher return. Uh, but think about it. Um, they simply switched place, isn't it right? This reduction in cash holding is actually increase, right, in marketable securities. So that way, And eventually, eventually total current assets increased. Then that's a good thing, right? Also, accounts receivable. Is this a good thing or bad thing? Accounts receivable. Accounts
Good thing.
receivable increased. Hmm?
Good thing.
I'm not sure. You're saying I only hear thing, but
A good thing.
it's a good thing. Yes, accounts receivable increase in accounts receivable is a good thing. Why? Because that means you made a lot of sale. Isn't it right? Accounts receivable means you have something to, you have payment to receive. Why do you have payment to receive? Because you made a sale. Isn't it right? That means your
Yes.
sale increased by, and I told you, um, uh, when you when you sell something, the payment is not necessarily in cash, right? It can be in cash. Some of it is in cash. Some of it is in promissory notes. Some of it is in accounts receivable. So if accounts receivable increased, it's a good thing, right? Now, inventory went down by 20%. Inventory went down. Good thing or bad thing?
Good thing.
Yeah, it's a good thing because uh, your inventory means what? Remember GAS, goods available for sale, right? Good. I forgot to take names, but uh, inventory means goods available for sale. And if your inventory, so if this is ending inventory, of course this is ending inventory because this is at the end of the year. And if ending inventory went down, that means they all went out. They all went out in sale. Isn't that right? They all went out in sale. So your ending inventory decreased compared to the previous year. Your ending inventory decreased compared to the previous year, end of the previous year, it went down. Or compared to the beginning of this year, your ending inventory decreased by 20%. That means, that much has gone, that much has been, gone in sale. So it's a good thing. And eventually, so this is really the meaningful thing. I mean, you just do this. It's mechanical. I mean, isn't it right? You can do vertical analysis and horizontal analysis, just uh, mechanically. But then the interpretation. I mean, why? Why do we do this? We want to see the change, but what is the meaning of this change? Huh? As the first example, cash went down. It looks like it's a bad thing. I mean, because without much thinking, without logical and analytical thinking, you'll just speak from the first impression, and the impression is, oh, cash went down, must be a bad thing. No, the cash holding, I mean, whatever isn't earning anything, if it went down, it's a good thing. And it's not due to the decrease, and it's not due to the decrease in the total asset size. I mean, total assets increased, right? If the total assets increase, that's definitely a good thing, right? And only the line item that doesn't generate any income went down, then it's a good thing, isn't it right? If the total assets went down and cash also went down, then that's a problem, right? That obviously isn't a good thing. But if the total assets went up, uh, total current assets also went up. Uh, Only the cash line item went down. It's not a bad thing, right? Everything else went up, right? Um, so that's the interpretation. I mean, I want to go do the interpretation of other things, but we just don't have time for that. But you can analyze it, like that, basically. Alrighty, so I think so. I forgot to take the names. There were at least three people that gave me the right answer.
It was Sadie, Dennis, and
Sadie,
Shirley.
but I think Sadie gave wrong answer,
You said it was
right?
wrong, but she did answer. She did try to answer.
Okay. And then who? There was Shirley, right?
Shirley,
And
Dennis.
Dennis.
And
Okay.
Jaren.
Who?
Jaren.
I'm sorry. John.
Jaren. Jeren.
J-E-R-R. Jaron.
Yes.
Okay. So I don't know how many right answers each people gave, but I will give everyone 0 0.5. Okay. Uh, only to the correct answers, right? Um, Alrighty. So, and so it's 412. Time is 412. Uh, this is a painfully slow progress, um, but there's no other way. So I think this is the right time to take a break, and so after we come back, then we're going to go into the next example. Okay. Alrighty. So let's take a 10-minute break. Let's take a 10 minute. So, what's going on? All right, we're back. We're back. Um, so here's an important point. In the previous hour, uh, Sadie said, and other people express. I mean, this is basically a idiomatic expression, or idiomatic expression is a habit. People have this habit of saying, making money. Oh, you made money. Then actually uh, we need to be clear about that. What does that mean by making money? I mean, we that means making profit actually, isn't that right? When we say uh, when we say you made money, or I made money, that means I made profit, isn't it right? Um, and So it's something like this. I have a some like Apple Watch or something, whatever, or Galaxy, watch or whatever. And I bought it. I bought it for like $200, right? And sold it for $300, or any at any price greater than the price I paid for. Then I say I made money, isn't it right? You cannot say you made money when you sell it for $200 again. You understand? Nobody says, I made money for selling $200 watch for 200 Apple Watch for $200. If you paid $200 and if you sold it for $200, um, nobody says, I made money, right? So in other words, if ever you made the $0, right? In that case, so you need to be clear about, we all understand the definition is, when you say making money, that means making profit. So losing money means making negative profit or making loss. Okay? But think about it. Profit and loss is income statement concept. Profit and loss is the income statement line item, the conclusion of the income statement, right? And the I was uh, the in the balance sheet, cash is not profit. Okay, you have to make that distinction. Cash is not necessarily profit. Okay, cash is not necessarily profit. Cash reflects, cash holding. Uh, so some of it may be profit, or some of it is, basically the part of our original capital that we raised, right? So that's why current assets are also called working capital. Why? You need uh, working capital to pay for the raw material. For example, if you're a manufacturer, right? You need uh, working capital to pay for raw material, right? And part of it, so part of uh, part of the cash is basically part of that. Uh, I mean, cash is part of the working capital, so part of the cash can be used to pay for uh, that came from our the original capital that we raised through sale of bond and sale of equity, sale of stocks, right? Uh, so cash doesn't mean necessarily just profit. Okay. Now, so our next example. So this is an income statement, right? So let's and I believe you may have these you may have the blanks already filled in. What does it look like? Do you have that filled in already? The highlighted areas? highlighted cells, are they filled in?
They blank. The new doc that you, yeah, was blank.
Okay, good. Okay, good. If it is blank, okay, good. Now we can start. We can get started. So first of all, so how do we know what the net revenue is? I mean, in the income, this is basically an income section, right? Gross sales, that's sales revenue. From the sales revenue, we made returns and allowance. There was returns and allowances, so we made refund, right? So subtracting refund, I mean it is already negative. So if you just sum these two line items, we arrive at this. But we don't have any clue. None of them are there. So we'll have to move on to the next section, next segment, which is CGS. Now, and then here's one clue. There's gross profit, and there's CGS. So think about it. What is gross profit? And I said, normally, we don't. Gross profit is also called gross margin, and this is not complete. Gross profit is not complete. I already, talked about this. So it can be misleading. So I don't use, gross profit. In my income statement, gross profit is relatively not it's not frequently appearing because it can be misleading. But okay, where is that thing? Okay, wait. We talked about this before. In the income statement, right? Income is basically consists of revenue and investment income. And then expenses, mainly, CGS, cost of goods sold, and operating expenses, right? Next. And then subtract that, called operating profit or EBIT. Now, only from here, only from this point, only from this level, we can consider that profit, right? Because all the expenses must be subtracted from income. However, sometimes they only subtract. Why did I do that? They only subtract CGS, right, from income. Subtract only CGS, right? And then the result is called gross profit or gross margin. Again, using the term profit here is already misleading because I've been telling you, until you subtract all the expenses, then it's not really true profit. You cannot really call it profit. And the true profit is, of course, net profit is the true profit because you still have to pay interest, right? Still have to pay interest, and then have to pay taxes. Only after that you arrive at EAT, which is also called net profit, right? So net profit is the true profit. I mean, even EBIT is not true profit because you haven't paid taxes and interest. But anyway, EBIT is pretty much EBIT is pretty much, considered like the first line or first phase of the profit, first phase of profit, right? And therefore, why? Because think about it. It's preliminary before interest and taxes. And when we are dealing with quarterly statements, taxes are not completely paid yet. Why? Because only at the end of the year, right? Only when after the year is over, then we make adjustment for the taxes. You understand what why people are so busy in April? Why? What's in April? Anybody?
The taxes.
Yeah. Tax season. April, it's tax. You have to. Why? Haven't you paid taxes? Of course you have paid taxes. I mean, but the tax return deadline is April 15th, right? And who gave me that answer? Taxes. Who gave me that answer?
Harold.
Harold. Okay, yeah. Harold. So 0.5. Yeah. Think about it. Everyone is busy trying to file a tax return by April 15th. And why do they pay, file tax return? Does that mean, people haven't paid, taxes in the previous year and they are paying taxes in one large lump sum in April of the next year? No. People have, think about it. If you have a paycheck, if you're receiving paycheck, you are every month, every paycheck, there is taxes already withheld from your paycheck, right? Every paycheck, every bi-weekly or monthly, taxes already paid. But then, why? So I paid all my taxes in 2021, right? From the tax withholding in the from my paycheck. So in other words, my employer is paying withholding the tax from my paycheck and paying directly to IRS, right? But then what is the tax return in April of the following year? It's adjustment, because all tax payment that is withheld from the paychecks are based on expected income, right? And then in reality, so the withheld tax may be more than what I actually earned, or less than what I actually earned. So in April, if I through 2021, if I haven't paid exactly the right amount, right, then I underpaid, right? Then I owe taxes to IRS. So during the tax season, I file file the form, and that will tell me whether I owe or if I'm owed. So if I had overpaid in the previous year, then I'm owed. Then I get the tax return. But if I owe IRS, I have to make that payment. So so because of that, you don't know until until what is the exact tax. I mean, we pay tax. The company has paid taxes through throughout 2021, but adjustment need to be made, right? Because we may have overpaid or underpaid. After that adjustment, right? We know what is the true profit, but until then, this EBIT is the preliminary, measure or rule of thumb, and then, but for people, but then why gross profit is? I told you gross profit is subtracting the CGS, only CGS from income. So gross profit is not the true profit. It can, and even between gross profit and net profit, still there is EBIT, right? So then think about it. If OPEX, if operating expenses is relatively small, right? If OPEX is relatively insignificant, then there will be very small, minor difference, only minor difference between gross profit and EBIT, right? Then you can use gross profit as a rule of thumb for profit. But in reality, what if the OPEX is a significant amount? This is not minor. The difference won't be minor then. The difference between the gross profit and EBIT won't be a minor difference, right? So that's why I'm saying that gross profit is not the true. It can be misleading. Some people may just try to sell the business, try to promote the business by saying we are. I mean, they have all the incentives to do that. Isn't that right? I mean, if their operating expenses are huge, they will try to hide it and only report the gross profit, especially when they are trying to get some investors, and they try. And let's say if CGS is small, then the gross profit will come out as a large number. It will come out as a big number if CGS is small, right? Then may give impression to the potential investors that this is a good business. And may give false impression, right? That's why I'm saying it can be misleading. Again, so you have to see EBIT because although CGS may be small, but operating expenses may be big, right? So then, if that's the case, gross profit is clearly not a good indicator, right? It can be misleading. But anyway, think about it. The idea is income minus CGS is gross profit. Then what does that mean? Income is CGS plus gross profit. Isn't that right? So it's just, very simple logic. I don't know what that is. Let me close that. So we already have a clue for net revenue because you see we have gross profit and we have CGS. So then we can, okay, I can figure out what net revenue is. It will be this plus, gross profit plus, right? It's the sum of these two, right? It's the sum of those two. Hit enter. And voila, that's our net revenue. And then we can figure out our gross revenue because gross revenue is this. It will have to be this, right? From gross sale, you subtract this, then that's the net revenue. So if you add them up, you get to gross sale. But here, one more thing, returns were already expressed as negative, right? So if you add them up, it will be subtracted. So instead, you will need to subtract, then it will be added. Okay? And voila. So we got now the gross revenue. Okay? Percentage will take care of that later. Now, this is net purchase, of course, net purchase, right? Remember, beginning inventory plus net purchase, that's GAS, right? And then after returns and allowances, okay. So basically, GAS in this case, it was, this plus GAS is this, this plus this minus this, but this is already negative, so you don't have to subtract it. Add them up, and it will be automatically subtracted, right? That's the idea. But then we don't know what GAS is, right? I mean, we don't know what net purchase is. We can only figure out net purchase from GAS, but we can tell what GAS is, isn't it right? Because isn't GAS? Think about it. Ending inventory is GAS minus CGS, right? Remember? So where is that? I remember, right? So if we go into the expenses, right? We have CGS and operating expenses. And in retail, remember in retail, CGS, the conclusion of the section is CGS. So we start with beginning inventory, right? Net purchase. Together, it's called the GAS, right? And from GAS, sale happens, right? So the cost side of sale is CGS. So you basically from GAS you subtract CGS and you end up with ending inventory, right? Okay, can't even speak. My throat is so hoarse. I mean, my voice is so hoarse. But I told you they switch this because the conclusion of this section has to be CGS. So what happened? So we put, we put ending inventory there, and then CGS here, because this has to be the conclusion, right, of that section. So think about it. That means GAS is then, because GAS minus ending inventory is CGS, so GAS is CGS plus ending inventory. Isn't that right? So based on that, we can find the GAS. Again, so it's GAS plus ending inventory, but you can't plus, because ending inventory is already in negative, so you will need to subtract. Then it gets added automatically. It will get added, right? Okay, that's our GAS. Now then we can figure out what net purchase is, because beginning inventory plus net purchase minus returns and allowances is GAS. So if we subtract from GAS, sum of these two, subtract sum of these. But again, in other words, we need to do, okay, something like this. This plus this, but then again, this is already negative. This is already entered as negative. So you'll just, normally they don't enter it as negative, but I enter them as negative because that way I can just, by using auto sum, it will be automatically taken care of, right? Normally they just enter it as, a positive number and they subtract it. But, because that's to be anyway subtracted, I enter them as, So by doing this, right? No, what happened? Net purchase B96, and this is then CGS. Right? GAS minus. Oh, what did I do? Why isn't it happening? I changed that. Okay. Now then this makes sense, right? Think about it. Using also, I'm gonna change this. I mean, it doesn't really matter, but I will make it using some command. I will make it more. Okay. Then think about it. This totally makes sense. This plus this, which is gross GAS, and then from that you subtract this. This will be subtracted automatically. Then it will become only this. I mean, just the rough number. I mean, just the rough mental calculation. You can, you can logically, at least the logic would stand that, oh, sum of these numbers minus this number, right? Just, rough mental math would tell you, oh, that, those numbers add up, right? Those numbers add up. So up to that point, we are done. We're good. Now then, here, operating expenses, right? Operating expenses. If you add them up, sum everything, that's going to be, OPEX. But here, OPEX is unknown, but depreciation is also unknown. So you cannot just add them up. But then, so how do we figure out what, if we know our OPEX, right? If we know, so operating expense, OPEX, right? What I generally call. I like to, remember symbols and acronyms. Do I ever use anything that is fully verbally all expanded? No. Why? Because when you have if labels must be succinct and concise. And if the labels are fully verbally expanded, then the table will be like, you can't live large on a spreadsheet. If the label is taking like, this much space, if one label is taking this much space, it is useless as a model. You understand? Huh? of course, I understand why some people are writing out, spelling out everything because they don't, otherwise they don't remember what it is. They don't. But we are doing financial statements, and what other? I mean, if it is current assets, you can simply you shorten it by acronym CA, and then just by, of course, not too many people shorten it even to that point, but CA, what would, in this context, in the financial statement context, what else would it mean? Could it mean California? Would it mean California? Huh? Yeah, of course, in postal context, CA would mean California, but we're not in that context. You don't have to spell out current assets. I mean, current assets, fine, it's not that long. What about, like total liabilities and equity? Why do you have to spell it out? If you spell it out like that, it takes too much, think about it. Liabilities, and they even write and. Can't you just use ampersand? Huh? Total liabilities and equity. I mean, if you spell it out like this, 2 columns, it takes 2 columns. That's not neat. That's not sharp. You understand? I have to use column F for data. But if you write it like that, just the label takes 2 columns, the space of 2 columns. That makes it very dull. That makes it very, what should I say, unprofessional and not neat. Okay? And in the homeworks, I make that, I write that comment over and over. Don't be verbal, don't be wordy. But some people still, keep being wordy. They have to, this is not a storytelling. I mean, that's English class. In the English class, you have to write out everything. It's a storytelling. I mean, of course, this is story. Everything is storytelling because we are telling a story that, but then not like that. We don't leave large with words. In finance and economics, we don't live large with words. Because if you live large with words, it's not sharp. You have to stay sharp. And to stay sharp and succinct and concise, you don't spell out, you don't fully write out everything. You have to use acronym, right? And who wouldn't understand? I mean, if you are in this context, you understand. CGS stands for cost of goods sold. You don't have to write it out, right? So, yeah, instead of writing it out, and what would this mean? Administrative cost, depreciation, advertisement, right? It's not, but anyway, here we have a clue. OPEX is 15%. 15% of what? All these, this is called, the vertical analysis is also called common sized statement. Common size statement. Common size. Why common size? Because regardless of the size of the total assets, regardless of the size of the revenue, I mean, company A and company B, there may be a vast difference in their size. In other words, company A may be, total asset size may be, 10 billion. Company B, total asset size may be, 10 million. And then obviously, then there's a 1,000 times difference, right? Company A is 1,000 times bigger than company B. And then obviously the revenue would be like, almost 1,000 times revenue might. And you can tell all the line items, maybe there's 1,000. But, just because company A is 1,000 times bigger in total asset size, that may not mean their profit is also 1,000 times. I mean, in other words, we measure, for example, total. So company A's total assets is 10 billion, and their net profit is net profit is 1 billion. Okay, then what would you say? Their return on equity. This is something, this is ratio analysis. Their return on equity, return on total assets is 10%, right? Their return on total assets. In other words, profit as the ratio of total assets is 10%. Whereas, let's say, company B, which has, only $10 million total assets. So the size is like 1,000th of company A, and their net income is $2 million. 2 million, right? So the net income, if you compare net income of company A with company B, obviously company A much bigger. Company B is only not even 2% of. Think about it. 2 million is not even 0.2%. Actually, 0.2% of 1 billion. So obviously you would say, oh, company A is great. They did, their net profit is much bigger. But if you think about who did better, company B did much better. Why? Because their return on assets, return on total assets is 2%. I mean, 20%. 20%, isn't that right? $2 million net profit over $10 million total assets, right? So it's 20%. Compare total, so return on asset is 20%, compared to company A, whose return on assets was 10%. Actually, this is smaller company, but much more profitable company, twice as profitable. Isn't that right? So it's like, I don't know if you've seen, ant is known to be very, ant is known to be the insect that that can lift 8 times its own weight, or 10 times its own weight. I don't remember exactly, but it can lift 80 times its own weight, body weight, right? So ant is the most, how should I say, productive or most efficient, energy efficient, right? Animal. Insect is also. I mean, compared to an ant, human being cannot even lift twice its own body weight. I mean, weightlifters may lift, twice their own body weight because they are trained, but average human being cannot even lift twice his own body weight. So compared to ant, which one is more energy efficient? Of course, ant is way more energy efficient. In other words, with smaller input, it creates much bigger output, right? So in that sense, so why did I? um, common, the reason I'm talking about this was common size statement, right? When you're comparing a small company with big companies with different sizes, right? You need to put them all in percentage. Otherwise, there will be no comparison. That's why it's called common size statement, right? So here, um, uh, what is the basis? Net revenue is the basis of the income statement. So, uh, because net revenue is 100%, so 15% of that is OPEX. So, problem solved. All we need to do is just net revenue times 15%. That 15% is given here. And I've been telling you over and over, you don't input this manually. You don't input 15% manually. The data is already there. Then you just make a link to it. Point to that data, right? There you go. Then that's operating expenses. And then, now we can find what is the depreciation. So it's basically from OPEX minus sum of, you're summing this, comma, and you can highlight all of these, that means B104 through the double colon, or colon is colon, as something through something, right? There you go. We got the depreciation. Then operating profit, or EBIT, is from, we subtract from, we can subtract from this net revenue, we can subtract the sum of CGS and OPEX. But since we have already gross profit, right, we can subtract from gross profit only the OPEX. Right, there you go. And then there was tax offset. And then operating expenses, operating income, and there is no interest in this case. Good. From EBIT is exactly also EBT. Operating income is exactly also the taxable income. So if you subtract taxes from that, we arrive at net income, okay, or net profit. Now the percentage, is simple. You just, divide it by whatever is, not that, because that is 100%. You divide it by this, and you lock that, right? Okay, you lock it, and then you can, come on, I locked it. All right, so, and then you can just drag down there, but then you cannot just drag it down like that, because then, so I'll just, again, divide this by this and lock. Okay, hit enter. And use always 2 decimal places, no matter what, 2 decimal places. 2 to 3 decimal places always, right? By default, always remember 2 to 3 decimal places. Now, I guess that's all the time we have now. So from now on, you would understand what to do. You can drag it down from here. Okay, drag it down. Okay, and you can keep dragging down, but don't forget to clean out the blank cells, right? All righty. So that's it for today. We haven't got to the ratio analysis. I hope, but the homework is already now. Homework is due today, but I'll make an exception because we were not able to cover ratio analysis, and ratio analysis will take more than one day, because hopefully, I hope we can nail it today. So it's, even if submitting it by midnight tonight. That's encouraged basically. But even if you can't do that, I'll accept it without any penalty. I'll accept it tomorrow as well because we haven't we still have to cover ratio analysis. Okay. Alrighty. So that's it for today. Any even if you have any questions, I don't have time to take it. I have to start. There's someone already booked for my office hour. So if you have any questions, please email me. Okay. Alrighty. So
Have a good one.
all right, you too. Take care, everyone.
Thank
I'll
you,
see you
Professor.
guys tomorrow. All right. Take care. I'll see you tomorrow. Okay. So I'll stop recording and.